Yes, good morning. Today we're going to discuss about accounting theory. Basically, why accounting theory is required. Coming from the introduction, we know historical background reveals that right now what corporate sector we have now, it have number of changes. So the changes have taken place over a period of time. So the size of the business has been changed, the quantum of the business have been changed, and how they need to do accounting at that changing scenario have created a need for having a proper theory which would justify the practice. So the changes posed some practical problems. So these kind of a what we have the problems like the changes like the change in the size of the business, change in the nature of the business, those changes created some practical problems to the accountants and make them unable to tackle with the changing condition, because these accountants what they do, they prepare the books of accounts in the changing scenario. When the changes happens in the business, then the accounting treatment also change. But there is no supportive theory. When there is no supportive theory, they cannot tackle with those changes, they cannot tackle with that changing situation. And the accounting practices and procedures which have been followed by the accountants have been criticized by many of the people on a lot of in lot way. Like what it means, accounting practices, whatever the accountants are following, whatever the procedures they are following, no, that has been criticized, because without a theory, if you practice, then obviously it is questionable how you practice this one. Say for example, without having a depreciation theory, we cannot charge depreciation. Then the question arises, why you are charging depreciation? Because of having a theory which tells us to depreciate and depreciate by following these methods. So that's why depreciation we are charging. But initially what happens when the theories are not available, then the practices of the accountants have been criticized, obviously. And the accountants were placed in a place where they are unable to give justification for their practices. And they do not have the confidence in accounting practices. But after a certain point of a time, when the theories have been developed, when various institutes comes in together and formulate the committees and worked on the theories which they have developed, now this the position of the accountant is comfortable one, because they can justify their accounting practice which is supported by the theories. And these accountant can substantiate their accounting practices because of theoretical support. Now they can give answer to the question which have been raised regarding their accounting practices. This is only because of the development of theories in the field of accounting. Yes, moving to the theory, the meaning of theory. Eric L. Kohler, he defines theories are nothing but it's a propositions which includes axioms, theorems, which together with the definitions and formal, informal rules of reference is oriented towards the explanation of a body of acts and treatment of a class of concrete or abstract operation. In simple words, if you want to tell what is theory means, it's set of some propositions, some principles, some statements, some theorems, where a few theorems are required to be proved, where some statements we need to accept without evidence. All those definitions, whether they are formal or informal rules of doing some activities, which explains how a particular thing has to be treated, that is what we call a theory is. A theory is nothing but a list of statements, a list of theorems, definitions, any rules of reference or any explanation which explains how a particular act should be performed. That is what we call theories are. So here propositions are nothing but a statement which have to be testable hypothesis, and the statement of belief which is generally and universally acceptable. Like see, all human beings have two legs that we believe, right? We will accept it. So axioms means, the word axiom is derived from Greek word axioma, which means thought worthy. So something which commend itself as evident. There is no need of having evidence. So we believe God exists, that is axiom. It is self-evident, there is no need of any kind of evidence. So these are what we call axioms are. Yes, what exactly theorems are? Theorems are the statements which is required to be proved. That is what we call theorems are. So they have to be logically proved. Then those we used to call as theorems. Now, what are accounting theories? Accounting theory is a model which represents something in real. So accounting theory is nothing but they are the rules which guides for practice. That is what accounting theory are. So they are the logical principles not only for the purpose of evaluating the current accounting practices but also for the purpose of justifying the current accounting practices. See, accounting theories are nothing but they are the principles which not only facilitate to give answer for the current accounting practices but also they gives they are helpful in evaluating the practices also. See here, they are the principles there which facilitates in evaluating accounting practices and justifying those accounting practices, then that we used to call as accounting theory. When it comes to the definitions of accounting theory, Eldon S. Hendrickson, he defines accounting theory as logical reasoning in the form of a set of broad principles. So they are accounting theories are nothing but they are having broad principles which is reasonable, which is logically testable. So that is those are the broad principles which provides a general frame of reference by which accounting practice can be evaluated, and it also helps in the helps as a guide for the development of new practices and procedures. So basically accounting theory is a set of principles which helps, which gives a framework for accounting practice, how can be evaluated, and also it helps in guiding the development of new accounting practices and procedures. That is what we call definitions are. Yes, see here we have the classification of accounting theories. Accounting theories as per Eldon S. Hendrickson. There are three classifications of accounting theories we can witness, that is based on prediction level. One is structural theory, interpretational theories and behavioral theories. And another name for structural theory is syntactical theories. Interpretational theories is also called as semantical theories, and behavioral theories also called as pragmatic theories. Coming to structural or syntactical theories, so it deals with the explanation of current accounting practices to know how the current accounting practices are carried out. See, the core concept of structural theories is it gives explanation for the current accounting practices. So at present what accountants are practicing, that is based those practices are the base for the development of these theories, that is structural theories. So accounting practices are compared with what theories state to find out whether accounting practices followed in by accountant conforms to what the theory requires. So why these theories have been developed, in order to have a check over whether the accounting practices practiced by the accountants are followed by the theories which have been developed. So when we look into the structural theories, we get to know what is the accounting practice currently practiced and what the theories is telling. Is it the same? To compare, these theories are required. This theory not only facilitates to know the current accounting practices but also predict how the accountant will react to a particular situation. See, structural theories are actually the theories which tells how the accountant is practicing at present. So these theories not only helps us to evaluate the current accounting practices but also it helps in predicting how an accountant will react to a particular situation. And say for example, if an accountant is collecting data, then how which are the methods he is using to collect the data, how he is processing the data, how he is preparing the books of accounts. So these things will be related to structural theories, and the theory makes an attempt to explain what practices the accountant have been following, starting from the data collection ending with the preparation of reports. So structural theories basically meant that information which will speaks about what is the current practices that an accountant is following while doing accounting, like how he is collecting the data, how he is processing the data, how he is showing that data in the books of account, how he is finally presenting the data, how the depreciation he is charging, all those practical things whatever happening, that has been put into the form of theories, and those are we call structural theories. After structural theories, we have one more theory which is called as interpretational theories. So what exactly interpretational theories speak about? So these theories focuses on how accounting information and concepts, how the information and concepts are interpreted by the accountants and the users. So interpretational theory, the name itself is indicating these theories speaks about giving interpretations to a particular accounting treatment. So the theory focuses on accounting information and concept, and along with that, how the information and the concepts are interpreted by the accountants. So it makes an attempt to find whether the interpretation of the concept by accountants similar to that of the users of accounting reports. So this theories helps in understanding whether the accountants what he wants to tell have been the same received by the users. Say for example, if accountant is telling sales revenue, then the users of that accounting information should consider sales revenue means the sales itself which had happened in the organization. So but there are some items where there is a difference in the way of understanding. Say for example, if we have taken expenses, we do not know expenses means whether they are speaking about the revenue expenses or they are speaking about the capital expenditure. So a proper interpretation should be given. That is what the core concept of interpretational theories. You know, different parties uses different users of we have multiple users who wants accounting information, and those parties, they are different, right? They can interpret in their own terms. So that's why interpretational theories tells whenever you are giving accounting information, the required data should be presented in the form of, along with the required data, you need to give some interpretations regarding the data which you have shown. And see here I have quoted an example where certain items which lacks good interpretation, say for example income. Income refers to which income? We do not know. We cannot get the proper meaning for this income. Like cost. So again, cost means which kind of a cost are you speaking about? We do not get the interpretation for this. So when these kinds of a theories have, then such a theory should give proper meaningful interpretation, and that is the core concept of interpretational theories. So interpretational theories mainly speaks about giving interpretation to a particular accounting treatment so that it can enable the users to understand in the same manner how the accountants wants to tell the information. That is what we call interpretational theories. And finally, we have behavioral theories. Behavioral theories we have which speaks about, say for example, I want to tell you, accounting is an information system, right? So by saying this one, there comes, it serves the users. So information system means there will be inputs, there will be process, and there will be output. So this information system accounting, it concentrates on giving the information to the users. So accounting, when we speaks about, it's an information system because it communicates the information to the users. When it communicates the information to the users, then the information should be relevant to the users, right? So what I need, that has to be supplied. Being a users of accounting information, say for example, I'm an employee, I want to know the company's profitability, that information has to be supplied to me. If I'm a customer, I want to know the company's profitability. Again, if I'm a shareholder, I want to know the company's profitability, that too earnings capability of the company. Likewise, so the users need for accounting information differs from one to another. So that's why this behavioral theory tells us to give information which will be required by the users to take up their decisions. So the theory aims at providing information to the users which gives utility of information, means useful information according to their requirement. So it focuses on satisfying the informational needs of users. So behavioral theory mainly focuses on giving satisfaction to the users by providing appropriate information to them, and it lays emphasis on knowing the behavioral decision oriented effects of accounting information statements and reports, because whatever the information has been supplied, based on that information only, what happens, the users will take decisions. So if they want to take appropriate decisions, the information supplied should be correctful one, a prompt one, an optful one. So that is the core concept of behavioral theories. It speaks about giving information which is required for, which is useful, which is opt to the users of accounting information. This is behavioral theories. Yes, now we have approaches for the formulation of accounting theories. So we had seen theories, right? We had seen structural theories, we had seen interpretational theories, we had seen behavioral theories. Now here we have how those theories have been formulated. So that is what the concept approaches to formulate accounting theory. How accounting theories have been formulated. So here we have descriptive approach, normative approach, ethical approach, sociological approach, and economic approach. So these approaches are helpful in formulation of accounting theories. One by one approaches we will see now. Yes. So the first approach we are having is descriptive approach. So descriptive, the name itself is telling this approach describes the current accounting practices followed by the accountants. See, as I told you, structural theories have been developed based on the observations which have been made by looking at the current practices, and the theories have been developed. No, this is what we call descriptive approaches. Descriptive approach, it focuses on how accounting practices are practiced by the accountants at present, and based on those they're going to develop the theories. That is what we call descriptive approach. So descriptive approach, through descriptive approach only we are having structural theories. So basically accounting theories developed on the basis of descriptive or positive approach explains what the accountants are doing right now, and it concerns over the practices followed by the accountants at present with regard to the preparation and presentation of accounting reports. So at present, how the accountant is preparing a books of account, how they are following, what procedures they are following, based on that if the theories have been developed, then that approach we call it as descriptive approach, and such a theory we call it as structural theory. So say for example, standards which have been developed by IASB. See, IASB, how they develop the standards, they identify the activities of the business enterprises with regard to accounting by noting, by identifying, by observing those accounting practices. This developed the standards. This is the example for descriptive approach. So what is the so here what is the subject matter of descriptive approach? How the data has been collected, from which source they are collecting the data, why from particular source, what methods they are using to collect the data, how the analysis have been done, how the financial statements have been prepared, and what are the contents they are having in the financial statements. So all these things have been noted, and thereafter the theories have been developed. That is descriptive approach. Yes, now we are having normative approach. Normative approach is different from descriptive approach. Descriptive approach, in that we are going to see the practice and we will write it up the theory. But under normative approach, what happens? It tells you how you are supposed to do. Like these theories are developed on the basis of normative approach, lays emphasis in what an accountant should do rather than what they are doing. Say for example, if an accountant is charging depreciation simply, then by observing that, this approach what it makes, it tells the accountant to charge depreciation either by following straight line method or by following some other methods, what they were supposed to do. That is what normative approach is. It tells how you are supposed to do the accounting. So under this approach, theory specifies the norms that the accountant should follow, should observe, and it relies to a greater extent on the process of deductive reasoning. Deductive reasoning means here what happens, specification. So specification means how you are supposed to do, that has been specified. Next, so deductive reasoning moves from making general statement to a particular statement with specification. Like generally overall they will observe and they will tell in a particular situation you are supposed to respond in a particular manner. That is what normative approach is. What is the subject matter of descriptive approach? See here. What is the subject matter of descriptive approach? We are having here how the accountant should. So in normative approach we have seen what are the data, how they are collecting the data, from which source they are collecting the data, what method should be used, how the analysis should be done, how financial statement should be prepared. It speaks about how it should be rather than what they were doing. That is descriptive approach. And finally, moving to the last one more approach, that is ethical approach we are having. Uh, Under ethical approach, accounting theories on the basis of ethical approach give importance on the ethics of an individual who is interested with the responsibility of keeping books of accounts. See, an accountant is holding a responsible job because he is required to communicate the information of accounting to the users. He should be an ethical one. He should be true. He should be fair because he will communicate that information. Based on that, the users will take up the decisions, isn't it? So that's why this approach tells an accountant should be ethical while doing accounting. So While discharging the duties, the accountant has to observe certain rules. He has to follow some provisions of various facts, figures, and then he need to prepare fairly. So, ethical approach based on theory focuses on three important aspects, that is fairness, justice, and truthful. So, the accounting information what you present, that should be fair, justifiable, and truthful one. So, DR Scott has suggested an accounting procedure must provide equitable treatment to all interested parties. So, the information should be provided equally to all, and the financial reports should present a true and accurate statement without any misrepresentation. And when it comes to fair, the data should be fair without having any kind of a partiality. It should be impartial without serving any special interest. These are the three things should be kept in mind while ethical approaches have been used to formulate accounting theories. And the next approach is sociological approach. Sociological approach basically helps in formulation of accounting theories by considering the social effects of accounting. So social effects of accounting in the sense we do accounting of a business firms, right? So those business firms might be in a manufacturing activity, might be in a service activity. So when they are the concerns which are operating in the society, they are using the resources of the society and they are harming the society. So this logical approach have facilitates in development of theories which will tells us to keep in mind the social welfare concept. So a company has to give to the society something. That is what the sociological approach is. So by this approach only we are right now having corporate social responsibilities theories which tells us corporates have some social responsibilities towards the society. They need to keep some fund for the social welfare, that is the due to sociological approach. Then finally, we have economic approach, and this approach places economic welfare at the center, and therefore the effects of different accounting techniques on the macroeconomic indicators should be kept in mind while formulating accounting theories. So when the accounting theories have been developed, if an accountant is following economic approach, then then the accountant should keep in mind the economic approach. That means they need to consider the inflation, they need to consider the poverty level, they need to consider all those stuffs. So various macroeconomic indicators they have to keep in mind while formulating accounting theories. So this approach expects to keep the economic reality and economic consequences in the mind while formulating accounting theories. So this approach tells us when the accounting theories have been formulated, economic reality we need to keep in mind at present, how the economic condition, whether we are in recession, whether we are in boom period, whether we are facing the inflationary situation. By keeping those things we need to formulate accounting theories, and the best example is inflation accounting for this. Yes, here we have some equity theories. So equity theories, when we speaks about accounting, it's basically meant to serve the users, right? It is called as a serving activity. So by saying accounting will serve, the question arises to whom it serves, and from whose point of view the entire accounting work is carried out. Is it from the point of view of the owners, or is it from the point of view of any specific objective? Hence, one can find few equity theories which have been developed, and those, see, so here we have some equity theories: proprietary theory, entity theory, and fund theory. These are the three equity theories which have been developed. So first one, proprietary theory. Proprietary theory also called as a ownership theory because it places owners as a center of business activity. A business is not considered as a separate from the owner. Owners and business has been considered same, and the personal property will be considered as a property of the business, and business property is considered as a property of personal. So that is proprietary theory. So the life of the business is purely depend on the owner's wills, whether he want to runs it or not, and all the transactions which is related to the business will be treated as a transaction of the owners, and the business is treated as a owner's business. So therefore the assets what the company having, that has been treated as the asset of the owner, and the liability is also treated as a liability of the owner, not of the company. This theory makes the task of ascertaining the results of business very difficult, because here what we do under proprietary theory, the owner's property and the company's property will be mixed. That is what proprietary theory is all about, because here owner is responsible. Owner, he will have all the things like he will run the business, he will responsible only to the business, and business is responsible to him. He is not responsible to anybody else. So that's why his personal transaction and the business transactions will be mixed, and when that mixture happens, now it become difficult to identify how the business is performing. So because owner's asset also considered as a asset of company, company's assets also considered as a asset of owner, then it become difficult to identify what is the performance of the organization. So that is proprietary theory, because it is not in use right now. The next category of equity theories we are having is entity theory. So entity theory, here the center of accounting is the entity. Because of the introduction of joint stock companies, the advent of joint stock companies made it impossible to manage the affairs of the company, because a large number of owners are there who are spread across the world, and this led to the development of stewardship. That means the management group, management, a new class of people who have been introduced to the business, and the management that managerial personnel will look after the business, and they will be called as the representatives of the owners, and they will communicate the information of the company to the owners. And therefore the business organizations now consider for all practical purposes a separate entity concept, which is the owner is different and the company is different. That is entity distinct from the owners. Entities means nothing but the business is different and the owners are different. An organization is considered having a separate entity distinct from its owners. That is the core concept of entity theory. Here entity will be treated as separate from the owners, and what all the assets of the entity will be called as assets of the entity itself, not of the owners. In the same manner, whatever the liabilities of the owners are there, that will be considered as a liability of owners, not of the company. Next theory what we are having, that is the fund theory. So it is one of the most important equity theories what we are having. So under this theory, fund is the center of all accounting activity. So under fund theory, neither the person nor the property means nor the firm will be placed at the center. Instead of that, fund is the center of the accounting. And fund theory considers the fund means the amount which is required to run the business fund, that has been considered as a basis of accounting rather than the owners and the or the entity itself. So fund represents the asset or group of asset or a sum of money or combination of asset and a money within an organization. So it is considered as an accounting entity under fund. So fund will be treated as a accounting entity under fund. All the transactions which cause either the inflow or out cash or equivalents are accounted from the viewpoint of the fund. Therefore, the fund theory lays greater emphasis on the sources and uses of the fund. So under fund theory, the major importance will be given to the fund, the inflow of fund and outflow of fund, from which source the fund has been generated and where the fund has been applied. That is the core concept of fund theory. The practical application of this theory you can find in various government institutions, government agencies, these NGOs, non-profit organizations. They make use of fund theory because they will create fund, and they will say for example budget what we are having. In the budget we are going to show the inflow of fund and outflow of fund. That is what we have fund theory. So here ends the equity theories and overall accounting theories.